8 out of 10 businesses that go to the market never actually sell. Not because they're bad businesses, but because they weren't built to sell. If you're building a 7 or 8-figure company, that should concern you. And today, we're talking about what actually makes a business sellable, exit strategy, valuation, and tax planning for business owners. Welcome back. I'm Ginger from WealthQuant, and we work with business owners on long-term tax strategy, capital events, and legacy planning. Today, I'm joined by Ray Kong, owner of Transworld Business Advisors here in San Jose, serving business owners across Silicon Valley and the greater Bay Area. Ray sees real transactions, real buyers, real deals that close, and deals that quietly die. Ray, you sit at the moment of truth, especially in a competitive market like the Bay Area, where business owners discover what their company is actually worth. How did you step into that world and become the owner of Transworld San Jose?
Hi. Yeah. Thanks, Ginger, for welcoming me here. I'm really excited to be here. And I think this is just a really important moment for a small business owner. So I'm glad to share what I see. You know, my story into business brokerage through Transworld actually came as a bit of a transition. So my career I started in the tech world, like many folks do here in Silicon Valley, worked at a number of startups, both pre and post IPO. Then about 14 years in, I decided, hey, let me see if I can actually buy my own business and run it. Because I actually came from a heritage of small business owners. Both my grandfather and my father owned a small business. And so I was interested in that. So I started learning from the buyer side, as they call it. Some folks, they call it being an acquisition entrepreneur. And that's where I learned the ropes on how to find some businesses for sale, to do the initial valuation, to do due diligence, deal structuring, financing, and all of that. But what I found out through the process of myself is I actually enjoyed researching those businesses, getting to know the business owners, and just loving what they're doing more than actually running the business itself. And so that was actually a really great insight for me. You know, it just happened that Transworld reached out and said, hey, your experience, you sound like you would be a really great business broker. Have you ever thought of actually doing this on both the sell and buy side? And that's how I became an owner of a business brokerage here in San Jose. So I get to now spend the majority of my time working with both sellers and buyers to do this all day long. So
That's a really cool story, Ray. And one of the reasons I wanted you on today is because when our clients, many of them here in California and the Bay Area, start thinking about a serious liquidity event, you know, we don't want them to think about theory. We want someone who's actually in the market every day, seeing real buyers and real valuations. And you're someone that we would be referring our business owner clients to when they need exit planning, consultation, and transaction level guidance. So you've seen hundreds of deals, especially in a high valuation market like the Silicon Valley. What's the biggest misconception business owners have about selling their company?
that's a great question. And I would say the biggest misconception with the sellers that I talk to is that profitability equals sellability. And that's actually a big misconception. And in fact, some sellers, they even go before that, where they say revenue equals sellability. And so they may be surprised when I tell them that the buyer market, buyers are very interested, first, not on revenue, they're interested on profitability. And then folks who understand that profitability is one of the key valuations that buyers look for, what they don't realize is that's just table stakes. That's what gets buyers initially interested and not look at a different business. But once they start popping up the hood as they speak and begin looking at all of the details in the business, there is a lot of different things that goes into whether a business is not just profitable, but is all sellable, which means transferable.
Yeah. So to add on to that, so when someone believes, like, let's say their business is worth 10 million, but then the market says it's only about 6, what's usually driving that gap?
Yeah, that's a really great question. And the first is actually, I want to recognize all of the great small business owners out there. I came from a family of heritage of small business owners. So I see firsthand my parents and grandparents, the sweat, blood, and tears that goes into many years in owning and building a business that provided for yourself and your family for decades. So some of this gap is actually perceptual. It's in the psychology of owners. You absolutely should be proud of yourself, owner, in what you built. And what is tough for owners is when they go to market, it may be the first time in their life where someone, as they say, called their baby ugly, right? That is not actually worth that. And that could be a huge psychological hit. So besides the psychological factors, there are some technical things. And the two you could always drive down to is risk and proof. So the risk examples is if you think about it from the buyer's perspective, that can kind of help keep the owner to think about the other side. For a buyer to buy it, what are all the risks in the business? Customer concentration, key employee dependence, the owner doing everything and being everything, or contracts that's hard to transfer. And then the other ones is proof. You may know that you have a great business, but if you can't prove it year over year with financials, tax returns, and it can't be verified, then that will show up in the valuation. Then the final thing I want to point out is us as business brokers, we invest in databases of comparables and history so that we know over many years what businesses actually sell for in your category, and particularly in your profit and valuation range. And so it's understandable that sellers who don't have exposure to that may possibly have an inflated value of what they think their business is worth.
That's great insight. And I've often come across a question from clients. Is it possible to run a profitable business and still have something that serious buyers don't want to see?
Yes, absolutely. And this goes back to the first point. So profitability brings buyers interest, but if the profit is real, but is fragile, these are some things that buyers will look for. What I referred to earlier, it's what's under the hood, right? So what gets buyers attracted to the business in the first place is saying that it's profitable at a certain range. But when they start looking into it in due diligence or talking to the owner, when they find some things that is fragile about the profitability, that starts raising flags. Now, of course, there's no perfect business, but there are things that we could look at when we're working with folks in doing exit planning to help them look at things such as owner dependent relationships, undocumented processes, messy payroll classifications, or businesses where you are the brand and you are the business. For example, a lot of clinics or restaurants or maybe even construction firms kind of have that. So what I want to get across to sellers is that it may be sellable, but what we're actually going for is transferable. And being transferable is something intentional and it's engineered, and it may not be how many folks were taught how to build the business from the beginning. So that's some of the reasons how maybe something can be profitable, but maybe not sellable.
Ray, so with your experience, what separates a business that gets one offer, no offer, from a business that gets multiple offers?
Yeah, absolutely. And I would boil this down to two things. And there's a lot of things that go under it, but I would say it's clarity and competition. So I've seen deals that get some multiple offers. Let me break this down a little bit. So clarity means the buyer has clarity in the business, clean financials, credible growth story, a business that runs without the owner. This is not a time for the seller to hide anything. Everything should come out at this point. And the second thing is if there's competition. Either number one, you are just in a hot category in the given market, you're just in demand, that drives that. But besides the up and downs of the market and what's valuable, what's in demand at the moment, competition could also be driven when buyers believe that your business is rare and is financeable. That's when you create a bidding environment, and that's when we get a lot of interest.
Let's say if you only had 3 years before exiting, what are the fastest levers you'd pull to increase valuation?
Yeah, absolutely. And I'd like to point out three levers, and they're on three categories, right? So we always look at the financials, we always look at the operational, and then we look at personal. So the lever number one is always financials, right? That's the thing that we could fix first. So you need to make the financials what we call buyer grade. That is monthly P&Ls, consistent categorization, clean add backs, and the ability to tie this to taxes. What a lot of sellers mistake for is that they believe that they could get some of their revenue back through tax optimization and also at the sale of the business. And the both can't be true. The both can't be true. We don't have time to dive into that right now, but that's something to think about 3 years before exit. The second lever is reduce owner dependence. So we need to document the how and you need to delegate the who and then prove it with your actual lifestyle changes. You could actually step back and you're not in your business, as they say, you're working on your business. And then The third lever that we always look at is de-risking your revenue streams. So customer concentration is always a big yellow flag. We want to diversify that. You want to look at if you could lock in recurring or contracted work where possible. And you want to strengthen some of the sales pipeline reporting or work in progress books and documented that. So that's easy to see. So these are some of the levers that we would look at when working with the seller on preparing them to exit.
Okay. And I'm pretty sure you get this question pretty often. When is the best time to sell a business? Is it when you're
Ugh.
tired or is it when you don't need to sell?
Ginger, I'm so glad you asked that. And this is one of the most counterintuitive things for sellers. And what I like to tell sellers is the best time to sell is when you're actually not thinking about selling at all, is when business is doing well and you're in the throes of like, you feel like you made it and finally this business is successful. And that's why I want to plant the seed to all the business owners out there. When you feel like you're in that state, that's when you need to think about the opposite. Oh, maybe this is the best time to sell. We have this saying in business brokerage firms that if for real estate, the best valuation comes by location. But in business brokers, the best valuation comes from timing. Timing is when you don't have to sell versus you have to sell. So I would hope all the listeners out there, if you're a small business owner, if you don't have to sell, that's actually the best time to start talking and preparing to sell.
Yeah. And how far ahead should someone realistically begin planning before going to market?
So realistic planning, I would recommend about 3 to 5 years is ideal if you want the optimal time. Now, of course, anything before the time for sale is better. But if you want to plan ahead of time, 3 to 5 years. Why? Is because most buyers, they look at 3 to 5 years backwards. So we need to make sure that your financials, your operations, and yourself personally is prepared with that 3-year timeline in mind, with tax returns, P&Ls, clean books. And it could take that amount of time to be able to work yourself off of the business so that it is transferable and it could work without you. So I would say 3 to 5 years.
That's good to know. And I know you mentioned about tax optimization previously before selling your business. It's you can't have both, right? But in selling
Mhm.
your business, especially in a high tax state like California, how many seven-figure exits lose six figures in taxes simply because they started tax planning too late when they're trying to exit?
Absolutely, Ginger. And you could probably talk more about this. I think this is your purview, but this is a great time to mention that when you're thinking about exiting, you really want to have the coordination and alignment of a group of partners all working together for you. So, of course, exit planning and preparation and brokerage, hope for me. And then I hope you work with folks like Ginger with wealth strategy and tax advising. And of course, your CPA for your books and your financials. Some of these three together will help with this. Even when I start talking with sellers about the different ways that they could sell asset purchase versus a stock purchase, and then it doesn't hit them till they're about to sell what that means for their personal taxes. And so you need to prepare for that ahead of time. And that is actually something what we do when we work with owners is that tell your wealth strategist, your tax advisor, what you want to do ahead of time in coordination with your exit planning, your business broker, and your CPA. So we're all on the same page to be able to help you. I think, Ginger, you know more. There's a lot of really innovative financial instruments these days that can help you probably protect the liquidation of probably one of your most valuable assets outside of your home here in California.
Yeah, we do help clients with that. And based on what you're seeing, Ray, like how long ahead of time should they start planning for that exit personally and inside of business?
Yeah. Okay. So this is what I like to tell owners. So before you're ready to sell, you should be spending your time positioning. And what that means is get you in the right place. So everything is done. Number one, personally, get clarity on your post exit life. Realize, and again, I want to give props to small business owners any chance I get because what you built is amazing. And it can only get even more significant when you transfer it and that becomes your legacy. And just know that this is just one chapter in your life story, not your entire life story. So getting clarity on that post exit life and what you're being pulled to and what you're being called for after you take off the hat of small business owner or business owner, and then to get prepared with your wealth and tax advisor for your cash needs, your estate, your legacy, tolerance, and the lifestyle that you want, and to support that. Now, inside the business, It's about those two things, financial and operational. Normalize the comps, clean up the personal expenses, tighten up the reporting. What we want to do is reduce the surprises that creates friction in the selling process. And by the way, I didn't mention this, that most sellers are surprised that statistically, it could take up to 1 year to sell a business. So this is not like selling a house. It is a real big endeavor. But the key is, so if you're not prepared ahead of time, both personally to be resilient through the psychological up and downs of dealing with buyers on top of running a business. And then in the business, if your business is not ready, it could be a lot of work at the time of sale to actually try to patch things up.
That's good to know, Ray. And so, based on your experience, what's the biggest mistakes business owners make 2 to 3 years before selling their business?
Yeah. And I mentioned this before, the biggest tax mistake, and I'm not a tax advisor, but what I see is that business owners think that they can get their money back twice. They can maximize their tax returns and get their money based off of deductions and expenses. But what that turns out to is then for the federal government, when you're submitting your tax returns to for a buyer to get funding, for example, from a bank, banks don't look at your P&Ls, they will look at your tax returns. So even though if you say you are a very profitable business and that's what it could be spun as the books, banks will look at tax returns. And if it shows that your business looks like it's not making any money, then that means you narrow your borrowing pool because then folks can't get a loan from a bank. So that is probably the biggest mistake with taxes. So you can't get it back twice. That's why we say, please plan 3 years ahead of time, work with folks as ourselves and with your CPA to be able to not make that mistake.
That's very important to know. And I remember previously you've mentioned that 8 out of 10 listings don't close. Why is that?
Yeah, I've been thinking about this statistic a lot. And by the way, the reason why I'm happy to be here is because I'm making it my mission this year to reduce these sad calls that I get where I'm trying to help them sell their business, but because they weren't prepared and we weren't able to work together sooner, they couldn't. And, reflecting on why 8 out of 10 listings don't close, I think it's because of this. I think because most business owners built their business to support their lifestyle, but they didn't build it to transfer to another person. And that's a really big mindset shift that, frankly, is just not talked about enough, which is why I'm happy that I could share some of my experience here. But I think that is the key shift. If you're building something to support yourself and your family versus you are building with the exit in mind and with your legacy, and that is transferable and is significant without you, that affects the way that you would build the business and structure it for many years.
That's a very important mindset to have. So, based on your experience, what percentage of business owners actually have a structured exit plan?
To be honest, a minority or maybe no, none. And that's really surprising me. And that's why I mentioned Ginger. I think I'm almost taking it a little bit personally this year. I'm making it my mission. I want to increase that percentage of business owners having a structured exit plan. So that's an opportunity for you. So I'm hoping to shine a light and even maybe scare some owners a little bit in the hope that we can do something. Structured means not some kind of dream pie in the sky, an actual plan. We have a valuation baseline, you have a diagnostic, and you have clear plans across clear categories of how to improve the evaluation and reduce the friction to sell and to be personally prepared, both psychologically and of course, financially and tax wise, so that it could be as simple as possible. So, thanks for the opportunity, Ginger, to mention that terrible stat.
Yeah, and I hope that, we can do it together. So, and this is why whenever a business owner tells me that they want to sell in 3 to 5 years, especially here in the Bay Area market, one of the first conversations I recommend is with someone like you to do an exit planning consultation. So, you've seen business owners sell for 7 or 8 figures and still struggle afterwards. What identity shift happens when someone runs a company for 20 to 30 years and then now it's suddenly gone?
Yeah. Again, mentioned the props of small business owners. I know this isn't just a business to you, right? This has been part of your identity. It's your role. It's your routine. It's your scoreboard. It's your pride. It could be your baby in many ways. And so it's not just a business to you. To the buyer, it may be a business. And so what I've seen is that owners who don't have a strong idea of where they're being pulled to and they have a clear next phase of their life, struggles at the time when they're clear they need to sell their business, but in the nitty-gritty of doing due diligence and you're in tough negotiations with buyers, there's just a lot of identity triggers there for the seller that actually is counterproductive to the actual selling of the process. And I think the root of it is actually this kind of identity. So if you have a clear idea of what you're being called to in the next phase of your life, and know if you want to pull in the significance of having built not just a good business, but a significant business that transfers, and that becomes your legacy, whatever you want to do, or just start a nonprofit, spend more time with your kids, or even giving back to your community or other small business owners and mentor folks. I could see that is a really strong anchor when someone needs for that post sale.
Yeah, that makes sense. So are there any like practical tips for people who are preparing for an exit to think about life after the business, not just evaluation?
Yeah, absolutely. And this is something that I love to work with owners as well because it's personal. It's not just financials and numbers in business. So first on the practical side, I would say we would build a pull plan. Think about this pull plan. What is pulling you, not just what is pushing you to the next thing. Examples of things that are pushing you is your energy, your health, your motivation, right? Typically, these are signals that you have to sell and not that you want to sell. But if you have a clear idea in mind what you're being pulled to, legacy, sowing into the next generation, right? Giving back, having a cause behind that. You want to start building up that side of your life so that when the eventual things on the psychological and physical side that may be pushing you towards an exit, that you want to make sure that the pull is stronger than the push. That's number one. And then number two is, you need to start designing that life before listing and before you're starting to get the LOIs. Otherwise, it'll be hard. You may unconsciously self-sabotage your own deal because unconsciously you don't want to let go of it. So if you know clearly what your legacy want to be and even have an idea of who you want to pass this on to. Now, I sell. So of course it's third party, but it could be in your own family. It could be someone that you mentored. It could be that manager that you raised up from hiring as a college grad. Those are also great legacy markers. And so some of those things, if you think about legacy and significance, that's some of the things that the practical steps that you could take in selling.
Yeah. Yeah. Thanks, Ray. So what we learned today is that, profit doesn't automatically mean it's a sellable business, right? A business has to be engineered for transfer and that takes time. So if you're thinking about an exit in the next 3 to 5 years, start the conversation now with someone like Ray, not the year you want to sell. So Ray, thank you for bringing the transaction level insight from the San Jose and Bay Area market to this discussion.
Thank you, Ginger, so much for having me. And I hope all the small business owners know that I love you and I hope we could help you here. Thank you so much for listening to this.